Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shub, and together with my partner and co host Patric, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Hey Patrick, we're back again. I know that we upload episodes a little bit later, so actually this is the first episode we are recording in 2025. So I guess Happy New Year to you and a belated Happy New Year to our viewers and listeners.
It's only late outside of China. So,
Yes,
yeah.
that is correct. That is correct. And to celebrate it, I brought along my fundamental hoodie, doing this episode at our office as well. So pretty excited to kick off this year.
Yeah, nobody should get used to either of the two things. Shub
Yes,
being in the office or Shub wearing hoodies.
that is correct. Especially the latter, I have to say.
Nice. So clearly a celebratory episode. Before we go into the topic for today, Shub, early last year, you said we would reach 60. I said we would reach 40, and I won by one episode. So
Yeah,
we
you
ended
said I think 50. I said 60, and I think we closed at 53. I think
53. Today is 54. Yeah.
kudos to you. I think we nicely throttled the pace at the end, which is fine. It's nice to have these situations where you can
Hey,
control
don't
the
blame me
outcome.
for that. That's not exactly how it happened. But
But
so
well done.
how are we ending this year, you think?
Look, I mean, if you take a purely analytical view, so last year we did, depending on again how you count the uploading and recording schedule, we did either 32 or 33 episodes,
Hmm.
right? So that should put us, again, depending on how you count it, either at 85 or 87 by
Hmm.
the end of the year. So
Hmm.
that's what the probability suggests. So where do you want to place your wager, Patrick?
I think we can be more ambitious. I think we can probably beat our pace from last year.
So this time you're going to be the aggressive one. So are we switching roles this time?
I'm gonna say 90.
90? Okay. I'm saying, you know what? I'm going to go perfectly average. I'm going to say 86.
Okay. Well, the ambition should be 100. So let's aim for that, and then we see what
Yeah.
happens.
Sounds good, sir.
Great. So we're starting the new year with reflection, Shub. So that's what people do when the year ends, and there's
Yes.
resolutions and etc. We all know how that works. So we are starting with reflection too.
hmm Yes, I think, and quite, as we look forward, filled with tremendous sense of optimism, lots of good things happened in 2024. Obviously, a lot of good things we do expect to happen in 2025, but it's also a good time of the year to reflect on how do we get better. And, one way, we often do that is to reflect on what we've done not so well in the past and how we improve upon them. So actually, one suggestion or a reflective process you suggested, Patrick, was to think about what we perhaps are the biggest regrets we've had in our investing journey and fundamental, which I think is a fascinating topic to think about, and also to consider what that speaks about construction tech and the fascinatingly different journey of investing in construction tech, and how each of these regrets or fallacies, whatever you want to call it, how it's also says something about construction as an industry or as a
And
space
I
to invest in.
think regret. So very quickly, your mind can jump to regret. It's that deal that I didn't do, or
Hmm.
it's that deal that I did, or
hmm
it's that exit that we didn't do. But actually, the regret that you and I want to talk about today, in the context of construction tech investing,
hmm
is the root causes behind those.
Yeah.
So, it's almost like if you're an athlete and you don't score a goal or you don't make a point in that, grand final,
hmm
1 minute to go, and you're not scoring. Sure, the regret is that you don't score, but truly the athletic mindset will be, hey, what did I do wrong? Why didn't I score? How did it,
hmm
maybe my um, golf swing wasn't perfect, or my throwing
hmm
motion wasn't perfect. that's the regret you and I want to talk about today. So it's not scoring; it's
Hmm.
why didn't we
Yeah.
score on that point? Um, and what triggered this, and I think this is an interesting lead-in to the conversation. So I spoke this week to to an investor I respect a lot, early stage investor, used to work for first one of the world's biggest and best known early stage funds.
Hmm.
When you hear the name, you would say it's top three worldwide for early stage,
Hmm.
just by brand recognition, not necessarily by other.
Hmm.
And then he worked for a vertical, sorry, for a SaaS investor, US and globally, um, as a partner.
Hmm.
Terrific track record, and since then became, his own fund, so became
Okay.
his own thing.
Hmm.
And I caught up with him, shot the breeze a little bit, reflected on things, and he talked me up on one of my portfolio companies. And I said, yeah, I mean, this could have been one that, where finally we would have another deal together, because we only have one deal together so far, which we've
Hmm.
never announced. Yeah, I said, this could have been another one that we could have finally done together. Um, just jokingly. And so he said, yep. And I didn't expect what he was about to say. So he said, yeah, Patrick, I really regret not doing this deal at the seed round.
Mm.
I didn't expect him saying that. And then he unpacked and he said, I'd really like to be part of the next round. I hope I can get my ownership target. I met the guys again in December, so about 4 5 weeks ago. Spent a lot of time with them, and I realized I had done a mistake.
Hmm.
And then I didn't have to prompt it, and this is what exceptional people do. He unpacked his own reflection about what
Hmm.
led him to the mistake of passing on the seed round that he now wants to rectify by being part of the Series A round. And
Okay.
he said one thing was the main issue he got wrong. He said, Patrick, this company is awesome because it starts very narrow. And
Hmm.
I love these types of companies. It's a technical team with a technical product and a technical buyer. It fit all my taste. But I repeated a mistake I had done before, and that is I over relied on customer references in a narrow market. The narrow market I loved, but I had a halo effect and didn't realize it, where I thought
Hmm.
that the feedback that the initial customers would give me in the narrow part of the market that this company is supposed to be in for at the time was reflective of the TAM expansion that the company would successfully do later. And the customers would tell me the same thing. And that was wrong. And I repeated that mistake. I had done it before. Um, and I'm beating myself for it. So that in itself is an interesting reflection. But I think the point for you and me, how we want to transfer, how we want to discuss today is, hey, that's the point, right? It's not about not scoring in the 119th minute of the World Cup soccer overtime final. It's
Hmm.
about what made you didn't score. And so this was the anecdote that triggered it. Maybe with this said, Shub, you and I reflected briefly upon our own misgivings and things that we hope to have eliminated from our
Yeah.
own book of mistakes. Why don't you lead us in with yours?
Yeah. Look, I mean, by the way, this individual, the feedback or the regret that he provided you, quite interestingly, I can relate to it in my own way, because actually that ties in very nicely with what my regret has been about the biggest mistakes that I have made so far in my career. And both on the, I guess, the false positive and the false negatives, it's a similar theme, that is listening too much to other people or letting them kind of get into my head to the point where my decision is based on what they're saying. So let me explain what I mean by that. It could be one of two ways. So one is, let's say I really like a deal, but for whatever reason, I'm not able to convince people around me. And by the way, just to be clear for our viewers and listeners, because the VC world is unusual and it has many different layers to it, when I see people around me, it doesn't necessarily mean my partners and colleagues. It could also mean other investors in the ecosystem who you look up to or who you move around with, who also share their opinion. for the most part, with good intentions in mind. So, what I found is, and when I reflect back, the biggest regrets I have is from situations where I really wanted to do a deal at some point, but I kind of got talked out of it by others. Again, well intentioned people who said, hey, this will not work for so and so reason, or there isn't really demand in the market for a company like this for so and so reason, etc. And on the flip side, the regrets I have about investing in certain companies also interestingly has been the result of, hey, everyone gets excited and you are not making the decision off of your own excitement or your own conviction. You're investing off of borrowed conviction of
Mm.
others, and then you kind of invested more with the sense of hope that, hey, their conviction amounts to something. I mean, interestingly, I think something we discussed, I don't remember if it was in Practical Nerds or in the super series we did with the Bricks and Bytes guys. In the most perverse form, the borrowed conviction actually becomes like the broker mindset, where you only invest in those companies where you believe someone else will do a follow-on investment. I would like to believe that's not what I'm referring to, but nevertheless, what I'm talking about is, in a crude way, what I used to tell myself is, this is the problem where you are no longer your own IC or your own investment committee.
Mm.
You have completely outsourced your investment decision making powers or ability to someone else. And when you do that, you sort of lose, you become hollow, and you no longer have the ability to stand for conviction, which in a very old school way sometimes is all we have left with, especially in very early stage investing, where you need like a kernel of diligence, a kernel of going against the grain, and where you stand against everyone else's opinion. So I know I've been rambling for a fair bit. So, long story short, my version of a regret is taking others' opinion too strongly, and letting it too easily overrule my opinion, and letting that form the basis of the decision.
What if they are construction experts, though?
Interesting. So I think today I have a different view of that. But back then, especially when early days of Fundamental, I had a very different view, I must admit. So when we started Fundamental, and by the way, fascinatingly, what I'm going to say now is what I observe many other peer construction tech VCs still do, by the way. And
Huh.
that's fascinating. So when we started Fundamental, I think we were also turned to many experts, incumbents in the industry, insiders, senior professionals in the industry, and so on, and turned to them for opinions on why so and so company maybe will do well or not, how this model will get disrupted, how this solution will be solved for. And obviously, again, in these cases, you'll get very well intentioned opinions by good people. Now, my thought process back then was, clearly they know way more than I do about the industry they're in, and obviously that is a fact. I cannot That is true, and I cannot challenge that. But what I did not realize, or maybe did not appreciate as much back then, and it seems very oddly obvious to me today, is, unfortunately, because of just how much they know about their specific business or the specific company, they also are completely unaware of how they will get disrupted.
Mhm.
And therefore, you cannot turn to them for views on how they will get disrupted, unfortunately.
So one
Now
of the
there might be exceptions. Sorry to speak over you. There might be exceptions, but then those exceptions generally only arise when you have someone coming out of the corporate setup with all the experience and the maturity it represents, and setting up a new entity or a new startup with the learnings they have, and then challenging the status quo.
right.
But with the exception of these kinds of things, you're kind of always, unfortunately, shackled by the limitations of the incumbent setup.
So I have I don't know if it's slightly more favorable or if it's just a different kind of learning view of the mistake that you switched off. Um, so for me, I want to rely on feedback I'm getting about specific or certain things, and I will tell you what those are. And I completely just my personality has always, for 41 years, not relied on another thing. And the difference is facts versus opinions. It is objective observations versus conjecture. So let me explain. On objective observations, if you think about construction, construction has thousands of different workflows. And in each workflow, it has nuances that are even regional, that are sometimes company specific, project specific. Everybody listening knows
Yes.
exactly what I'm talking about. And that means that there's very rarely a factual observation or objective observation that applies to all of construction. I mean, very rarely is that true,
Yeah.
except for certain first principles or things that are close to first principles. For example, construction likes to buy outcomes. Okay. So, on that level, once you have abstracted these core rules of the game, there are a few of those that apply. Most of the details, by far the most of the details and nuances of construction, do not translate to every part of the market. That's important because when I look at companies that have a certain vision, that have a certain long-term vision, but also that have a promise in maybe a subset of the market, a wedge, a niche, etc. There are ways how I can get factual observations that relate to this specific subset, wedge, or niche today. Now, the conjecture would be, hey, how is it going to be? Or is your opinion that this is going to work, the change that they are doing? I'm not doing that. My personality is in general not set up for that way. So that's like a just constitutional upside or benefit that I have to the job that I'm doing. But I do think that you can use experts, people in the know, to actually give you the factual observations. Hey, this is what the company is currently doing. Is the market really like that? Is this how the workflow works? Is this what customers today are doing, and how often are they doing it? How many of them are doing it, etc. So when I don't need people to conjecture or give me an opinion based on assumptions, I tend to be supplied with good information. And the job of then layering in assumptions, layering in logic, how the assumptions plus the facts might be playing out, that is then internalized by me. So I think that's completely fine. Now, there is a stakeholder group that I think you can externalize nothing to your point, Shub, and that is other investors. Because
Yes.
the other investors actually, they just do an exercise of adding or layering in assumptions and logic that I'm supposed to do, and they
Yes.
don't layer in facts.
Yes.
And sometimes they even layer in bad incentives. Hey, it's my portfolio company and it's the next best thing since sliced bread. I mean, I still
Yes.
remember this funny episode of an investor in Renault Run who told Adam, our US partner, in 2020 or 2021, Adam asked him, hey, how's the company doing? I
It
mean,
was
it's in
actually, I think, just before Christmas in 2019. I remember the specific.
2019. Okay.
Yes. Yeah. Yeah.
Completely innocent question just to kick it off. And this guy goes into, dude, they're absolutely killing it. Great. What is the GMV? I'll have to get back to you. Oh my God. Like,
Yeah.
um, but this is the shit that you get when you try to externalize your thinking to other investors. So I think there's an interesting nuance here. And so construction experts can be relied upon, but you have to make sure you're not asking them for conjecture or assumptions.
Yeah. So that is true. I think there's another aspect which is somewhat unique to construction, which we have discussed in other episodes on Practical Nerds. But I think it also relates to this specific aspect that I just spoke of. And that is, say, let's say if you're talking about software or cloud or consumer tech, most investors and ecosystem participants have at the very least seen through a few cycles of adoption, new change, uh, uh, companies becoming mainstream, scaling up, etc. In construction tech, as we have mentioned several times on this podcast before, we're kind of only at the dawn of that happening right now, right? So quite literally, it's like being around 95, 96 and trying to make a prediction of how internet is going to change our world. Most people at best have wild guesses, but no one can really say. And I think uh, everyone has their best guesses, and some unfortunately take on the role of being authorities on what they think the future will be and present it with reference to what you said as fact when it's not really fact. It
Yes.
is at best a wild guess, a wild extrapolation at best, right? And many times it's not supported by anything underlying as well. And because no one really has seen any cycles, because those cycles haven't played out, no one has any such authority, and yet people are pretending to be authorities. You can also get swayed by people thinking that it's all little construction tech will do is just replicate similar cycles they've seen in other quote unquote similar industries, which have, by the way, nothing similar with construction. But you randomly extrapolate these things, and therefore I find this advice is particularly dangerous, especially if you intend to make an early non-consensus bet, which could be an outlier, or as we have spoken before in this podcast, a category creator.
But I think, Shub, there is, with regard to relying on external information from experts, there is something. Sorry, I'm making this term up now, but I think it's actually accurate. There's something like an expert query fit.
Mm-hmm.
So in construction, if I ask a back office person a question about, hey, how is this workflow actually working on the construction side?
Yeah.
Most likely they will tell me, I don't know. An
Mm.
idiot would try to make shit up, but I could sniff that out, and so
Yeah.
could you. Um, but if I ask them, and so if I ask them about, can you connect me to a person that actually runs this workflow,
Mm.
and ideally pick one that has done so for many years, they would connect me. So that's just it's just an expert query fit that isn't there. If I ask that back office person that question.
Yeah.
Now, if I ask a finance manager in the back office, hey, how are you currently booking invoices that you receive
Mm-hmm.
from the construction side? There might be an expert query fit, right?
Yes.
Different point. If I ask a construction site manager on
Mm-hmm.
a project that is on a project that is the right size, the right type of project, etc., for the startup I am evaluating.
Mm-hmm.
Hey, how is currently your inventory management process after you receive new materials on the day you receive it? Very
Mm-hmm.
specific question that is objective, that deserves an objective and factual response. And
Mm.
that person is actually managing that workflow. Shub, I can 100% rely on that. Now, I cannot
Mm.
rely that is repeatable. So that is my job now to ask the same question to someone else that has such an expert query fit to make
Mm-hmm.
sure whether that is repeatable or not. And that's a little bit the problem that this investor that I was giving the anecdote going into the conversation, he over relied on repeatability of feedback later in the term expansion. That's my job now. But on
Yes.
the individual feedback, I can rely on that. So there's an employee query fit. Here's the analogy.
Mm-hmm.
To your point, because I think you're saying, hey, certain disruption cannot be anticipated by people on the inside. Fair enough.
Mm-hmm.
So let's go back to, let's say, 1900 roundabout.
Mm-hmm.
And there was a technology transition from horse carts to cars with combustion engines.
Mm.
And the famous saying is, if I had asked people what they wanted, they would have said faster horses. Okay,
Yeah.
fine. But now let's use the analogy, right? So at that point in time, Shub, if you and I had been around and we were venture capitalists and we were investing in technology, blah, 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 we could have gone to the following people. We could have asked an engineer that is building horse carts.
Mm-hmm.
We could have asked something like a logistics manager, or let's say taxi driver, that
Mm.
is running horse carts and carrying around people.
Mm-hmm.
Or we could have asked a back office manager in a big logistics company using horse carts.
Mm-hmm.
So I know with this analogy, if I ask the horse cart manager, hey, what do you think of combustion engines? I
Mm.
already know what's happening. There's just no expert query fit here. If
Yeah.
I ask the back office person that has a fleet of horse carts carrying around people, hey, tell me how the horse cart is currently performing. What are the biggest issues for the clients, etc.? Most likely, I'm not getting an employee query fit. If
Mm.
I ask the horse cart driver about, hey, how are you currently running your workflow? How are you loading people? How are you unloading people? How long are the routes? How often do you switch over?
Yeah.
What are the biggest issues with the horses? That is employee query fit, because I'm going to get objective factual advice.
Mm-hmm.
So in this instance, I probably would have gone with persona number 2 in order to collect factual, objective information about the workflows that he
Mm-hmm.
currently has. And then from there, I would have built, and then I would do that a lot of times to see whether it's repeatable and consistent, blah, blah, blah. And from there, I would have to layer in assumptions and logic to come to the conclusion whether I believe in combustion engines or not to replace horses. That's what we're saying here.
Hmm. Now, look, maybe I'm going to give a very cheeky response, but obviously it's very easy for me to take that route because we know how things played out. Obviously, another view to take might have been that actually, if you take a specific vintage, let's say a specific 10-year vintages, even in the year 1900, you may have actually done better by investing in a better horse provider
Hmm.
because the automobile with the combustion engine, to not until Henry Ford developed the forget what it's called, the supply chain that he did for the
Assembly
two
line, the
lines.
moving assembly
Assembly line,
line.
exactly,
Yeah.
thank you.
Yeah, the moving
Right,
assembly line. There was assembly
right.
line before, but that was the moving assembly line. Yeah.
Correct. So until then, you had cars, but it was seen more as a novelty, and they were not particularly fast. So in fact, it was not even answering to the customers' demand for faster horses. Quite often, they used whale oil and stuff like that, which led to a lot of pollution.
There was
Uh,
infrastructure missing for the combustion
Correct,
engines. Yeah.
right? Cars are very accident prone. So, depending on which vintage of the fund we're talking about, you and I might have been better off investing in a better horse provider, frankly, and maybe waited for the early cycle to reveal that cars are a bad idea for now.
Yeah.
And once someone actually has this unique insight of, hey, this is what problems need to be solved, then act on that. And at that point, now, of course, all this is very easy for me to say because that's how history is played out, and for
Yeah,
better
but
or
that's
worse,
how we
I
learn.
correct. And at that point, I think, obviously, at that point, you should not be, or we would not be well served if we interviewed um, horse carriage drivers or stuff like people of that sort. We would probably have to ask ourselves: can cars go too far, and what is missing? And is this assembly line, is that going to solve the problem?
Or are there enough gas stations? Can they fuel up in enough places? That's
Correct.
exactly right. Because if I
Yeah.
ask that, any of the 3 personas, I will actually not get the correct answer because I'm asking for conjecture. And that's not what I should be asking.
By the way, I'm glad you brought up this unique example because quite often I use this example to highlight why it is not always obvious to jump on the AI bandwagon.
Hmm. How are you using it as an example there? Sorry, it's a quick detour.
Yeah, it's that it is. So I'm not in disagreement that AI will ultimately be tremendously transformative for everyone, right? But the form in which it is being quote unquote implemented or taken up by early stage ventures, is it really symptomatic of a winner already available, accessible to us? Or is this cycle meant to be taken by the hyperscalers, the large companies, and then they fight it out, and then a better model is discovered, and then you
That
wait
is
out?
awesome. That is
Yeah.
awesome. So, actually, in the analogy, in the year 1900, arbitrary number now, maybe you shouldn't have invested in Ford, but you should
Yes.
have invested in a gas station provider as you're
Correct.
building up infrastructure. And maybe investing in Ford would have been the 1915 bet
Yes.
that you want to make.
Yes. Correct.
I follow 100%
Yeah.
because I see the
Yeah.
exact same thing in AI for AEC. Right now, I want to invest in the pipes. I want to invest in the ERPs. I want to invest in the ontology. I want to invest in the authoring tools. And maybe in
Yeah.
3 years, 5 years, whatever the time frame, I then want to invest actually in the generational AI companies.
Very nice. On that note, we actually haven't gotten to hear what your regret has been, Patrick. We fell into this deep rabbit hole with all kinds of diversions.
So I have one. So like we said, going in Shub, right? So regret can be a deal you didn't do, a deal that you did, or you overinvested in, or sometimes an exit that you didn't do. So for me, the just in terms of the business or the ball that I didn't score, the throw that I didn't make, it is over allocating capital into one company too quickly. And the reason behind that, now to come to that, and the true regret is in that company, we didn't give ourselves enough temporal diversification. So let me explain what happened. It was a company, it is the year 2020 and then 2021. And
The good times.
the very, very good times, flush with cash. At some point I felt, people always say that concrete is the second most used material on earth after water. These were the years where maybe it was dollar bills
Yeah.
after water. Good times. And so here, this company had shown and demonstrated very quick growth. It hadn't demonstrated the unit economics for it, though. That was problematic. The
Okay.
working capital situation of the company also wasn't worked out. Why? Should because the company was 1.5 years old when it raised its Series B. We were previous investors. So now comes the Series B after roughly, I think it was more like one year, 9 months, but it doesn't matter. Like, that's insanely quickly. And now it raises, I'm not going to give the number, because if I give the number, people will be able to reverse engineer what I'm talking about, and that's not the point. But it raised a Series B that today would be a small IPO.
Yeah.
Huge Series B. It had, the dynamic that it had in fundraising was that people were reaching out to them and beg them to place money, even though
Yeah.
they weren't even in fundraising, just because left and right other investors were placing money in them and were
Yeah.
talking well about the firm, and this is the next rocket ship, all that crap that we as a VC industry did in these years. So back to my regret. That was the context that happened. And then comes the Series B. The company only a year, 9 months maybe old. We were involved maybe for, I don't know, a few months in that firm since we invested early stage, because the rounds happened extremely quickly. And the unit economics were just not okay. And the working capital just wasn't okay. And we knew that. But now come, I think in this round, I want to say 3 revered investors, deep pockets, gave them like a small IPO round size. And you're sitting here and you're asking yourself whether you want to do more investments into this firm. And what we did here and what I did here was advocate for more investment into the company. It was very quickly growing, so that was amazing. It hired a kick-ass team. So one of the indicators of greatness or potential future greatness, among many others, is also what kind of talent you can attract. And that was just truly world-class in this company. And it still is, by the way. The company is still going. So there were indicators that did that. Now, the one thing that I didn't account for in my follow-on decision was temporal diversification. That is a real thing. So if you give yourselves as an investor time between allocating the first money, the second money, the third money, and so on, you're achieving the ability, and that way you're temporarily diversifying. Hey, maybe the first investment was 2020, the second was 2022, the third was 2024.
Yeah.
With this temporal diversification, what you're achieving is you're giving the firm the ability to generate data points and objective facts for you over the course of different market situations, maybe different competitive realities, maybe certain other adversities that the team has to navigate. And so you're allowing yourself, first of all, the firm and then yourself, the ability to work with this additional information to see how robust management actions are, how robust the model is. You're discovering issues that you didn't expect or were unknowns before. But if you don't do that and you cram too many of your allocations into too short amount of time, you're exactly not getting that. It's almost as if you would have invested the same amount of money at the previous round
Yeah.
because it's so compressed. And that was the mistake. And I swore to myself not to do that again. It's good to have gone through that experience. Luckily, it happened in a fund that also, to a degree, up to, due to you and your investments, is highly profitable. So we're not, let's say, in that fund vintage, we're highly profitable. And luckily, that was able to absorb the money that, we probably shouldn't have placed into the next check there. And that way, it was we learned from it in a good context, but still it pains. It's painful. And so I swore to myself not to repeat that mistake again, to a degree where, to give you an example, in Fund 2, so this was a Fund 1 company that I spoke about. In Fund 2, a portfolio company of mine I led the previous round, and then the company was doing a next round relatively quickly after.
Okay.
And the company was going out with a certain number as a target, how much they wanted to raise, and a certain dilution target. Let's say 20%. Let's round it a little bit. Relatively classic.
Sure.
And the company, not only did it raise relatively quickly, which was in a way awesome because it had traction for it, but it didn't give me a temporal diversification. More so, they accepted more dilution and more money than they originally targeted because they were multiple times oversubscribed. And I said to the guys, originally I wanted to make you an offer to do this. I'm not going to do that. I'm only going to do that. And I'm going to support you that way. But to me, it doesn't make sense to have that valuation with that dilution, that amount of unnecessary capital in the firm in that short amount of time. And the founders understood. They appreciated the transparency. And I had been also leading up to this. I had been very transparent with them. Very mature founders. And so at the next round, I might now double or triple down because that has given me temporal diversification. So that's for me a big learning. And I think, in construction tech, now bringing it into the construction tech context, I think this risk of not achieving enough temporal diversification is even more real than in other sectors for one reason. Construction is still maturing as a venture category. And a feature of a maturing venture category is that you can have in certain quarters of a year, of vintage years, you can have insane consolidation or concentration of capital into 1, 2, 3, or 10 companies. And if your portfolio company is one of those, that obviously feels like a huge win. But it can also be a reflection, not necessarily of it's an amazing company. It can only sometimes be a reflection of, hey, this is the only company that fits the narrative of the external investors that don't know the category as well. And because it looks like other things that they have seen in other markets, this is where they all pile in. But you as an existing investor, you as a specialist, you as someone that has asymmetric information about the firm, you should be like, no, hold on. Actually, they don't deserve this kind of money right now. And you need to be disciplined to pull yourself back. That's true in every category, but in a maturing category, this phenomenon of external money piling into companies that perhaps are not deserving is a little bit more pronounced, and construction is in that stage.
Well, there's a lot to unpack in what you said, and I could also see that perhaps recollecting some of these things from the past may also have been a cathartic experience for you. So
Yeah.
I'm grateful that you went into the details of it all. I'm torn between going one of two ways as a immediate response. One is like an old wisdom, which I think I've also learned the hard way or through the last decade or so. But I think I want to park that for now, and instead, what I want to do is, because if I take on the role of our viewers and listeners, especially the founder community, they're probably listening to you and going, hey, are you saying you don't want us to raise rounds in quick succession, right? Because isn't that what founders are supposed to do? So what would you tell them, Patrick?
I do when you have built sufficient validation compared to the previous time that you raised money. If you're loading up with, so that's that. Secondly, there's a difference between you raising money and you raising money from me. There's a difference there. So if you can raise money, but you don't, let's say you did one round with me, and then someone forces money onto you in 3 months from now, in an extreme example, which does happen.
Yeah.
Now, do you in 3 months expect me then to double down? That's a very unfair expectation, because you have actually not created any new kind of information that allows me to revisit my previous check and my
Yeah.
previous exposure. Typically, depending on we're early stage investors, Shub, you and I will lead pre-seed round, seed round, and the team here, pre-seed round, seed rounds. Of course, we do our pro rata. I mean, that's not even a discussion. But if it's, let's say, between a Series A pro rata check and a Series B, and that happens in 3 months, and now you come to me and you expect me, hey, please double down. I'm like, no, you have not given me new information. And by the way, are you really sure that it's good for you? And if the founders think it is, because someone else is maybe stupid enough to give them this kind of money, then let's go for it. But there's a difference between accepting it from someone else and expecting it from me.
Yeah. Yeah. I hear you. You know what I wanted to go with, and so you and I have discussed this a few times. One old wisdom I had heard, which applies to VC, and which again I've only come to appreciate as I've gotten older and spent more time in VC, is that no matter what you think, what the typical sequence is, you first find out who your losers are in your portfolio, then you find out who your winners are, and then you find out how big your winners can get,
It's
right?
brilliant.
I think we always keep forgetting that. We think somehow, by the way, this applies to me as well. Somehow we think we are geniuses, and we've immediately figured out that this company is like already the winner, therefore we're like piling it on. And I think why this old wisdom is particularly true for construction tech, as you and I have been saying in this episode, is we are only at the start of like the first cohort of great companies. So actually no one knows what's coming next, what form and shape they'll take, etc. So we are all kind of in it ourselves. So it's a very weird form of game theory playing out in front of us. So to judge based on an event like fundraising and to conclude based on that it's a winner, and not have other reasons to know where they stack up rest of your portfolio, you're probably shortchanging yourself.
I think we're doing this long enough now to know that the founders we partner with never have a linear path. I think that's a wisdom that many people have come to realize. And the paths are oftentimes like this. Goes up very quickly and then it goes down.
Yeah.
It takes a long time to go up a little bit and then it goes up very drastically.
Yeah.
I think in our portfolio we have these examples. And by the
And
way,
by
by
the
long
way,
time,
yeah. Sorry, go ahead. Go ahead.
by long time, so just by long time, I'm talking 5 years, because
Yeah.
sometimes it takes 5 years to discover a winner.
And by the way, even if it keeps going steadily like this and then goes up, that also doesn't exclude the possibility that then from there it again falls in, and there's various interpretations of what fall means. Each situation is different. Then it goes back up again it falls, and then you kind of get to a more steady state situation.
So that's exactly the third path I wanted to highlight. You've preempted this, is it goes like this. But the
Yeah.
overall trend line goes to the up and to the right. But if you
Yeah.
pick any specific month, quarter, last 4 quarters, you might be overexcited or you might be underexcited. I mean, our job is really a lesson in when in doubt, zoom out. When in doubt, zoom out. That's really important. I mean, you really discover your winners, I think, only after 5 years
Yeah.
in a fund and later.
Yeah.
And that also means, by the way, for founders, that you truly only discover whether you are a winner after 5 years. You can discover whether you're a loser quicker, but whether you're a winner, you can only discover after 5 years.
But Patrick, tell me, so there are founders listening to this, and I think we might have covered this topic indirectly in a couple of episodes before, but I think maybe we have deliberately not answered this specific question. There might be founders listening here and saying, okay, you know what? I know what I'm doing. I'm on to the next big thing. And maybe I'll get Patrick on my board in the first round or not, whatever. And I'll work on getting the next round as soon as possible, and it'll be a great round. I don't care. I mean, it's still surely it's a great outcome for me and my company, right? What's there to lose? But what's your take on that for founders who believe this?
I will support them in doing that, but I will also tell them transparently that I believe it's not something that they should do. There are certain exceptions where it can make sense. So, for example, if high minimum feature set companies. High
Mm-hmm.
minimum feature set companies, in the context of temporal diversification, have the special characteristic that within 3, 6, 12, or even 24 months, you cannot build additional validation that will tell you whether the core bottlenecks of your business, you're closer to it or not. All you can build is features and some kind of usage, some kind of anecdotal evidence, etc. But it's the opposite of a marketplace or an outcome as a service, where on a daily basis I can build validation to myself through transactions,
Mm-hmm.
through the higher frequency of transactions than I have in high minimum feature set companies. So CAD authoring tools would be a high minimum feature set. A lot of robotics companies in the first year and a half would be like that.
Mm-hmm.
And so these are exceptions where, if it does take you a long time, during the phase where it takes you a long time to build high minimum feature sets,
Mm-hmm.
at that point, I would always accept capital at substantially higher valuations, or even no valuations, uncapped notes, for example, because then it becomes you are accepting capital at future terms from investors that are willing to accept the risk of no validation of the high minimum feature set. So in
Yeah.
those scenarios, I would be very favorable of accepting something like that. Whereas if that's not the case and you can actually more gradually build step-by-step validation, it's
Mm-hmm.
very rarely the right thing to do, I have noticed,
Yeah.
for the founders as well.
Yeah, in fact, one thing we specifically discussed in our episode on burn, one problem which unfortunately founders in this situation only realize too late, is it's actually not necessarily a good thing to rapidly raise rounds, because a large round quite often also means a large valuation, but also a large dilution, because whatever valuation you set now is the new floor for the amount of expectations baked into the company and what you need to deliver for the next round. Uh, as you brought up in the two examples that you mentioned, as well as many other examples we are aware of outside our portfolio and in, when you better do that only when you're very confident. And when I say very confident, I don't mean it in the pre-seed venture-ish style exuberance. I mean it in the very clearly forecastable level of confidence that you can clearly deliver an upside to investors coming in. Because if you're not able to deliver that upside to investors putting in a lot of money at, let's say, an inflated valuation, all that money is really not going to be and the valuation is not going to be accessible to the founders in any case due to
Yeah.
liquidation preferences and the like.
There is another exception that comes to my mind where I can build on what you're saying, where accepting more money, regardless of temporal diversification or early on, does make sense. And that is the case of a founder that has a truly exceptional capability
Mm-hmm.
to already know the fifth, sixth order consequences of where the company will go. It's almost never a first time founder.
Hmm.
Um, it's founder that will have the ability to know exactly where they're going, and by where I mean like 5 years, 10 years out,
Hmm.
exactly what they need to have to build, exactly in what kind of sequence, and exactly what kinds of resources they will have to do. And
Hmm.
they have reduced the entire journey of the company to that vision, to an execution risk. There's no market risk. There is no unknown unknowns. There always is, but like you know what I mean,
Yeah.
conceptually. And in these cases, a founder like that can do the following thing. A founder can say, I try to load up with as much cash as I can up front, as long as people give it to me, but I will cap it at the amount of capital that I think I will need over the lifetime of the company. And
Hmm.
that's different because almost every fundraise in VC is never approached with that mindset. It's always loading up a gas station to the next gas station point.
Yeah.
But if you can truly project how much capital you think you will need to make
Mm-hmm.
your vision over 10 years a reality, and then someone gives you that capital, that eliminates the need to do another fundraise.
Hmm.
Almost, founders, if you think you are the one that is able to do that, be very honest to yourself whether that is the case. There is probably a very small number of people on this planet that within their domain can actually pull it off like that. But in an edge case like that, there you don't need temporal diversification.
The interesting thing is the way you laid out, not exactly, but most of the facets of what you described as such a case is what I remember being the rationale for why firms like Thrasio and all other roll-up firms were being funded. Because
Hmm.
the argument was that, hey, it's very predictable. You know what the money will be used for, and the money will be used for an immediate uptake in revenues and consolidation of uh, entities, etc. And obviously that also amounted to nothing. I mean, for those of you who are not aware, Tracy
Yeah.
also went bankrupt. So it's very interesting. I mean, we underestimate the power of unknown unknowns in venture and what is truly
Yeah.
predictable and what is not. I think we quite often maybe take things for granted, especially when large sums of money are involved.
I mean,
Not
another
everything can be
example.
solved by money. Yeah.
Yeah, another example of such a rare occasion or rare instance could have been the 450 million seed round that Andreessen gave to Adam Newman for Flow.
Hmm.
So that might have been, I'm not privy to the inside knowledge here, but maybe
Hmm.
that was the thinking that Adam would only need this one round and he got the capital that he needed to make his vision a
Hmm.
reality, and everything else after that would be dead. Maybe.
Hmm.
That would at least fit the description of the situation at founder that we were just discussing. But that is
Hmm.
such a rare exception. Usually you will need to account for temporal diversification as a founder and as an investor.
Yeah. Indeed, sir.
Good. Good. This
Yeah.
was a nice reflection kickoff into the new
Yeah.
year.
Absolutely.
Great. Then, Shub, are we doing any new rituals on Practical Nerds in 2025?
I'm inclined to say I'm too lazy to change rituals at this point. So maybe we stick to what we have. But hey, if you're feeling particularly excited about some new ones, happy to give it a try.
Maybe we tinker around again this year with some live episodes. Maybe
Okay. You
once
mean
a month
streaming
or so.
live on LinkedIn? For those of you who've stayed with us since the very first episode.
Yeah, that was raw back then. But I did a live one yesterday with the Bricks, Bucks, and
Oh, nice.
Bytes guys. That one was stable. So that one was good.
Okay.
So maybe it's worth revisiting again.
Okay.
Yeah.
Nice.
All right, sir. Well, happy weekend.
Happy weekend to you, sir.
Cheers.